think the Senate is going to take those business provisions and make them permanent because they have a little more headway, I think, over there in terms of deficit finance spending. Where I don't think they're going to make provisions permanent is probably on the individual side. I think that's more for political reasons. I think that is something that Republicans would like to campaign on in 2028 to sort of put Democrats, on the defensive there and hope to motivate some individual voters to come out. But I think the big thing to watch moving forward is, when the Senate starts to turn up some of those dials on permanency, that's going to increase the amount that they're going to add to the deficit in the eventual package. The House is comfortable with $2.5 trillion in terms of adding to the deficit. The Senate's going to be comfortable adding probably closer to $4.5 trillion when all said and done. So where are they going to end up? And I think, what's the bond market reaction going to be to all that?
RenMac Off Script originated as a weekly internal research meeting designed to summarize and discuss what happened in Washington, the markets, and the economic data over the past week. It was always intended to be and remains a free-flowing conversation with no discernible objective other than to extract the wisdom and opinion of our analysts and their expertise. This is a conversation among colleagues. Individual circumstances are unique and nuanced. Do not mistake these conversations for investment advice because it's not. Here we go.
All right, welcome to RenMac Off Script, where we openly discuss markets, economics, policy, history, and life. It is Friday, May 16th, 2025. I'm Steve Duttenhofer.
I'm Jeff deGraaf.
I'm Neil Dutta.
And I'm Steve Pavlik.
As a reminder, all the charts we reference are posted to our Twitter and LinkedIn accounts. For those who are investing their own dollars, I encourage you to be a RenMac Access subscriber at renmacaccess.com. And for those on the institutional side of the business who aren't already clients, feel free to reach out to sales@renmac.com for more information on how we can help you navigate the market. So big week last week. Maybe we start with the Knicks.
I'm under protest that I got kicked off doing this thing, by the way. I don't know what happened where I somehow got the boot. I don't know if there was a committee. Is there like a back channel committee that I don't know.
Well, as the viewers on the YouTube can see, it's primarily a function of who's more handsome.
Wow. Well, then, look, I realize this is less like the Premier League and you got to wait all season to get relegated. This is more like Major League Baseball, and there's a fine line between, pro ball and getting in the show and AAA. So I go week to week.
Wow. All right. I got it. Okay. Yeah. I'm turning off my camera and going back to my bus.
I mean, you always said you had a face made for radio, so.
Yeah, that's true for sure. Yeah, Neil, so what's going on? Yeah, I mean, the Knicks were supposed to get swept. They're like on the verge of potentially winning tonight, which I will hit on because
let's see.
What do you think? And we found out that a Knickerbocker is like ancestral.
The Dutch. You're
Dutch.
Dutch.
I'm Dutch, which I'm offended. I think we need to take that off for speaking for the Dutch people around, that we need to turn it into something else that's, our movement has come now to get rid of the Knickerbockers.
Well, you could go back to the you go back to the Bad Boys Pistons if you want, Jeff, since that's what your lineage is.
Those were great. That was great. I grew up with that. All right, Neil, talk to me about the Knicks. What do you see? You like them tonight? You think they're going to take it at home?
I hope they take it at home. It's better to be done sooner than later. I feel like I'm on the verge of potentially reliving my teenage years. The thought of
you're vaping again?
The Knicks and the Pacers in the Eastern Conference Finals. The only thing that's missing is the NBA on NBC theme music, right? I mean, but
Hannah Storm.
Yeah, right. Bob Costas, those great intros about sort of setting the dramatic background on. Anyway,
I don't
know. I mean, it is interesting. I mean, you do have a lot of sort of carpetbaggers like Kylie Jenner and Kendall Jenner,
Steve Duttenhofer.
Becoming Knicks fans overnight. I mean, we'll take it, but let's see. Fingers crossed. I like their chances.
Just a quick stat. So home teams are posting just a 31-30 record in the playoffs this year. It's the lowest since 1981. So the whole home court advantage thing it just doesn't seem to be resonating this year.
Yeah, I
We'll
mean
see.
the Knicks are responsible for 2 of those losses, right? Because they beat the Celtics. They basically stole 2 games in in Boston. So we'll see. I mean,
I'm finding value in the Celtics money line. Not that I want the Celtics to win. I'm just finding value. As an investor, I'm finding value in that money line. Anyway, let's go.
Well, that's a great segue into investing. So I want to start to shift gears a little this week, start a little different from equities. I know there's a lot going on there with the RenMac retest rule and the deGraaf thrust indicator, which obviously we're going to get to, Jeff, in a little bit. But I want to start with the bond market and yields, because I think it brings together 3 aspects of our macro shop into play. There was an interesting analysis this week from the Tax Foundation, which I know Steve's going to hit on. Jeff, you had some comments on the market action this week. And then, of course, Neil, you've got some insight into the inflation growth and the Fed aspect too. So, Steve, let's start it off with you, if you would. There was that, as I said, that tax scoring or Tax Foundation, lots of stuff going on there. Give us your thoughts on that.
Well, what they're doing is trying to make the case for Republicans to extend a lot of the business tax provisions in the House bill to make them permanent. And I think the rationale is businesses like certainty. If you can provide some of that certainty through the tax code, you can get businesses to invest more, stimulate investment. So I think that's essentially what the Tax Foundation does. Now, to be fair, they tend to be a right of center group. They are providing this at a time when House Republicans are still trying to cobble together their, I would say, opening offer as part of their reconciliation package. Again, I think the Senate is going to take those business provisions and make them permanent because they have a little more headway, I think, over there in terms of deficit finance spending. Where I don't think they're going to make provisions permanent is probably on the individual side. I think that's more for political reasons. I think that is something that Republicans would like to campaign on in 2028 to sort of put Democrats on the defensive there and hope to motivate some individual voters to come out. But I think the big thing to watch moving forward is when the Senate starts to turn up some of those dials on permanency, that's going to increase the amount that they're going to add to the deficit in the eventual package. The House is comfortable with $2.5 trillion in terms of adding to the deficit. The Senate's going to be comfortable adding probably closer to $4.5 trillion when all said and done. So where are they going to end up? And I think what's the bond market reaction going to be to all that?
So, Jeff, maybe turn it to you. What has been the bond market reaction? Not to this necessarily, but sort of in the last couple of weeks, and sort of your thoughts on that.
Yeah, look, I think the interesting part within bonds, 2-year yields, let's talk about it from a yield perspective, not the bond price perspective, right? So when prices go up, yields go down, but let's just talk about yields because they're more quote unquote relatable. 2-year yields are coming down. And as we see, that trend is still in place. 10-year yields are a little bit more mixed. Now, they haven't, at least not this morning that I saw, haven't broken out through that 475 level. That would be uncomfortable in terms of the equity market valuation. So we're still in that range, which is good news. But the long end of the curve, the 30-year, actually looks like it's about to break out. 5% there on the 30-year. And, as we said in one of our notes this week, if the 30-year were a stock, we'd buy it, or we'd tell you to buy it because it looks like it's kind of poised and basing. So, the real question is why is the longer end of the curve moving higher? And I think Neil should weigh in on this. But it really comes down to, growth prospects, inflation prospects, and then this notion of supply and the refinancing that we have to do and deficits and the fiscal order of the U.S. government. So, all those things are kind of working simultaneously. The good news is from the market's perspective, when we look at sectors, we look at styles, we look at those other things, it's not suggesting a disaster. So, you would not expect cyclicality to be making a new high versus defensives. If this were a referendum on growth, that just wouldn't be happening. Obviously, it would be more troublesome for the cyclical side of the ledger. That's not happening. So I'm hopeful this is just your normal steepening of a curve as you go out of an inversion. But it doesn't feel like that in the economic data. But I think, we can obviously let Neil opine on that a little bit more.
Well, I think part of what's going on with the long end is somewhat global in nature. I mean, if you look at Japanese longer term government bonds, I mean, the yields on those have been surging. So I think it's part global. I think it's part fiscal negotiations that are ongoing, and the threat of a wider budget deficit and increased treasury issuance. So that's part of it as well. So I think those are the two primary factors, and also the sort of residual. Things aren't falling apart. Growth is hanging in there for now, and that's kind of keeping this underpinning of selling pressure, I think, in the back end of the curve.
Hey, Neil, I have a serious question for you. There's seasonality in gold, and it tends to. I'm looking at the chart. We posted it on Twitter. It tends to be very soft historically, May, June, July. And as our resident Indian, is there really something to this Indian wedding thing? I mean, our Indian, the whole idea is that there's this. I'll put it out there. This notion that there's a lot of gold transacted for Indian weddings as gifts, and so the price of gold is artificially high. Is it Indian wedding season?
Yeah, we got cultural appropriation going on from the.
I'm asking because I can ask Duttenhofer, but I don't think he's going to have the answer.
Nope.
I have no idea. Most of the gold that was in my wedding was fake. It was fashion jewelry. So.
Mine too. So
I don't. Funny story. I mean, the most gold I got actually was from friend of the show's Drew Mattis. For my wedding gift, he actually gave me a gold coin. That was the most gold I actually got at my wedding.
Yeah. But he's an Austrian economist by nature, deep down.
It's the only gift I got that actually went up in value since. Thank you, Drew. But at any rate, I have no idea. I mean, it depends. I mean, I don't know. I mean, Indians, I would not want to get married. I got married obviously in the States in September. If you got married in the summer in India, that would be brutal. So, I'm not sure if there's seasonality.
Yeah, well, I don't know if that's it. But there's a spike in August, so maybe it's front running towards. I don't know when the weather's nice there, but certainly it starts to pick up in August and September. But I bring it up not just casually, but because it's one of the things that I think you can use into the equation of what's happening to the back end of the curve, which is gold's rally can be seen as inflationary. We usually historically the best indicator for gold ends up being the consumer confidence, right? Low amounts of confidence provide a backdrop for a more bullish outlook for gold. High degrees of confidence obviously are less so. So the good news, from my standpoint or my seat at least, is that we have seen a correction in gold. We thought gold would correct. The sentiment was running super hot there. The positioning was running hot, where people were, net long the futures market. They were excessively long in the ETF flows, et cetera. So anyway, so I think that's a good story, or at least part of the story, part of that mosaic of the story for what we're seeing in the bond market. So let's at least hope so.
But with yields now, in that 5% range, I'm sure that puts mortgage rates, I don't know, it's 7.5%, something like that. Is that now going to choke off the housing market? And then, sort of along the same lines with that, in terms of growth, you had an interesting piece out this week, sort of around oil prices and how the oil prices. I know Trump's over in the Middle East, not only getting a new $400 million new whip, but he's also negotiating some stuff over there about getting oil prices down. Right, a supply shock. And I think you have some thoughts about what that does to our economy, which is a little bit outside conventional wisdom. You think about oil prices, right?
Well, let's start with the housing. The housing data has been universally bad. Whether you look at soft measures of data like the NAHB Housing Market Index, which crumbled in May to a level we haven't seen in over a year. And that's going to, I think, set the table for ongoing weakness in single-family residential construction. So we see that single-family permits are down, single-family starts are down. You have, overall starts are running below completions, which means that units under construction will keep coming down. And you have increasing inventory in the resale market, right? So at the margin for builders, they have more competition in the resale market. And the slack is building in the new single family market. I mean, they're sitting on more completed unsold inventory. So there's more reason for builders to kind of focus on getting rid of the things they've already built as opposed to breaking ground on new homes. And so that's going to weigh on residential investment, I think, for the next, the foreseeable future. But it's really tough to kind of make the math work with interest rates up this high. Now, in terms of energy, I don't know that there's been any announcements around energy. I just think it's interesting that, Trump is going around trying to diffuse tensions all over the Mideast, whether that's with Iran, with, there's also obviously the Israel and Hamas situation. He's trying to kind of make a diplomatic push to resolve Russia and Ukraine. These are all, this is all very energy sensitive. Russia is a big oil producer, and if sanctions come off, you would assume that, and that there's no war, you would assume that there's more energy production, which just sort of brings me to a bigger point. I mean, I don't really think President Trump cares exactly how oil prices come down. I just think that he cares that they're down so long as he's president. So this idea that we're going to have like massive crude oil production in the U.S. to kind of drive prices down, that's not really working out because you're really generating the positive supply shock overseas at the moment. Whether that's the Saudis kind of trying to discipline OPEC members or what have you. That's at the margin going to be weighing on U.S. investment because, to profitably drill a new well, you need oil prices at least around $60. So to the extent that we're running below that, I mean, the math becomes a little bit more challenging. But, I would just say that the sign between the currency and the oil price has kind of flipped since the U.S. became a net sort of producer of energy. And, if you get a positive supply shock in oil through diffused sort of geopolitical tensions, oil prices come down, and that represents a negative shock to the U.S. terms of trade, in which case the dollar would go down. So, that actually kind of, is in line with one of the goals of the administration, right, is having a weaker currency. So, people talk a lot about like a Mar-a-Lago Accord, and there's some chatter around currency with what's going on with South Korea and so forth, and some of these Asian trading partners. But one way to get the dollar weaker is basically through a Doha or a Riyadh Accord, I mean, you can call it, and basically generating a big supply shock globally to push down the price of oil. I mean, remember, Trump has very much a 1970s view of inflation, right? Which is if you take care of energy, everything else sort of falls into place. I mean, there might be I do think there is some merit to that. I mean, obviously, oil prices matter a lot for like the monthly, particularly when they flow into gas prices. That hasn't happened yet, but it matters a lot for the monthly swings in inflation. Let
me ask a question though. Does it also put pressure on Putin and other, obviously oil and gas exporters? I mean, if he can kind of hit them from the pocketbook side, doesn't that force him to come to the table a little bit more on peace talks? I mean, isn't this a little bit of a 1-2 punch?
Theory, I mean, you get oil. I mean, that you're just cutting off their war funding, right? Right.
Which I'm sure he wants to do.
Yeah, I mean, it's just remember that's coming at the expense of, increased production in the U.S.
Yep.
All right, let's switch to equities a little bit. Last week we were on this pod. We talked about the RenMac retest rule, which is suggested a low probability we would retest the lows. Then this week we saw a spike in 20-day highs, a solid escape velocity signal, otherwise known as our good friend Ned Davis has called it, the deGraaf thrust indicator. So Jeff, is it safe to say that the worst is behind us in terms of the equity markets?
I think it is. Look, there's no guarantees, warranties in this business, but this is a probability business. We talk about it all the time. And we're always looking for things that help to skew those probabilities. And, I had a conversation with a client last week, and we were talking about stats, and look, we look at stats and statistical significance, and it's very hard to find things that are statistically significant in this business all the time. A lot of times you have to look at economic significance and, again, kind of shift your thinking. I mean, think about it like a horse handicapper, right? There's nothing that's going to tell you statistically journalism is going to win the Kentucky Derby, right? I mean, it's not. You just have to kind of look at what the probabilities are, and are they offset enough to warrant it being a good investment. And it's the same thing with what we're doing with some of these indications. The 20-day high is something that we developed back, 20 years ago now maybe. But the idea was, when we went through and looked at what was happening in bear markets, you really never saw 20-day highs expand in the way that they expanded this week, which just says, look, once you get to this level, once you get 20-day highs expanding, then you've got a much better probability that you've taken the downside away, that the worst of the bear market is over. We talked about that with the retest rule, right? When you're down at least 20%, and then you have a 50% retracement of whatever that bear market is, 20, 40, 50%, whatever it is. Once you get that 50% retracement, it's very, very unlikely that you undercut that low. So all these things are just little grains of sand that help that probability of taking the downside away. Again, it can happen. I mean, it did happen in 2008. We didn't have the 20-day high rule in 2008, but you certainly we had the 50% retracement. We went and undercut that meaningfully, and that was really the only one that was meaningful. And there's other ways that we have to look at that, to say, hey, this is not holding up the way it should. We'll reserve those for clients, but certainly that is, as we look at kind of that probability scaling and stacking ideas as to where we are within this mix, I think you can say with a reasonable assurance that if this is like those other times, we've taken a lot of the downside away from the market. Now, that's thinking out the next 3 to 6 to 12 months. We can do a lot of things in the very near term, but the way that I'm handicapping it for clients is saying, look, if we get weakness, which isn't assured, but if we get a pullback or a consolidation, that should be used opportunistically to buy it, not to fear it.
But on the flip side, we've had investor sentiment sort of shift a little bit this week, right? The first time we saw the AA bulls outnumber bears in that survey. You've been highlighting for a while that that bearish sentiment is going to be a good tailwind for equities as the market moved higher and sucked people in. Is that now moving to a headwind? And then Neil, I want your take on it, because as you pointed out this week on Wednesday, the stock market has not yet internalized the risk of a material slowdown in the economy, at least from your view. So, Jeff, is sentiment now a headwind?
No, I don't think it's a headwind at all. I mean, keep in mind that sentiment is really a reflection of historic returns. I know the street wants it to be the other way. That sentiment is somehow forward-looking, but the evidence is that if you tell me what returns are for the last 13 weeks, I can tell you much better how many bulls or bears there will be than if you tell me how many bulls or bears there are today and where the market will be in the next 13 weeks. So the sentiment is a reflection of people's willingness to kind of endorse what's happened to the market. We just ticked up. I mean, it's barely more bulls than bears, and actually there is evidence that shows when you have a substantial number of bulls in the early parts of a bull market, that's actually confirmation of the bull market. So I think sentiment's a long way, Steve, from being a headwind or an impediment to equities. We'll watch some of the option data to get a better read on say the industry groups. One example I would just say, we have seen some of our option data signaling on household and personal products. We saw it in distribution retail, which is like Costco and Walmart. There was a lot of enthusiasm there, which were staple names, right? So as the as the cyclicals kind of overtake the staples, we expect that enthusiasm for those names actually starts to wane and drops a little bit. So to answer your question, I don't think that we have any kind of problems in terms of sentiment being an impediment to this market.
And Neil, to you, the thought is that, a lot of the news flow has been around tariffs. That's what's driving the market higher, at least the way you look at it. We haven't, at least the market hasn't sort of digested the probability of a slowdown. Is that right?
I mean, I think so. I mean, if you look at the move in the stock market, just looking at like why it's been going up, I mean, a lot of the recent move is basically because of this detente with China, where you've taken down tariff rates. So, I don't think it's the market like speculating really on economic news. It's just the market responding to what is going on, with respect to trade. And so that, we haven't really seen like how the market would respond to bad economic news. I mean, there's been some hit to the soft data, but people are looking for that to kind of, show up right away in the hard economic data, and that hasn't happened yet. So, that's notable, I guess. I also think, the administration seems to be moving on to the more sort of growth-friendly parts of its agenda, so that might be helping buoy equities. But we haven't really seen for yet how stocks would sort of react to a meaningful weakness in the economy. I think that's just something to keep in the back of your mind.
That's great. Thanks. Well, it's mailbag time. I want to bring in Harry Chen, our resident mailman. I'd also like to remind everybody that if you submit questions and we choose it for this portion of the pod, you get a nice new RenMac trucker hat, which is good for the beach, the lake, and apparently driving a truck. You can submit those questions via Twitter. I guess I really should say X each Thursday when we post the tweet. So, Harry, all you.
Okay, today we have the question from Nick Both. The question is, does any data both soft and hard carry anywhere near the signal that is normally thus given the ongoing trade war? Which data has strong signal regardless of tariff and trade negotiations? Thank you.
You left out part of that, but does any data, both soft and hard, carry anywhere near the signal that it normally does given the ongoing trade war? Which data has strong signal regardless of tariffs and trade negotiation, and which data is currently useless? I've got my take, but let's hear Neil's take on this.
Well, I think a lot of the hard data it's hard to extract a big signal from it. I mean, retail sales is a good example because you put tariffs on, that will lead to front running, right? Like, so consumers will pull forward their spending of goods, and that'll juice the retail sales data. At the same time, there's some expectation that tariff rates will come down. That may actually weigh on consumer spending because consumers will delay purchases of goods because they think that tariffs will come down. So they're waiting to catch those lower prices. So it's really hard to get a meaningful signal, I think, in some of these, important indicators that we keep an eye on. I think it's important to look at things that it's, sort of hard to shift around because of tariffs, the most obvious being people. So that's why I think employment is still, really important. That's why I think that's sort of the most important indicator. That's kind of cliche, but it's especially the case now. I'd say also to a lesser extent, maybe like housing demand, right? I think if you're a consumer, are you really worried about tariffs? I mean, you're probably just looking at like where the mortgage rates are and deciding, I'm going to try to get a loan. And, so I think that might be another one. Service sector consumption is maybe another, hard to kind of shift around your spending at restaurants because of tariffs. But I think employment is really paramount.
Yeah, I would just say, to add to that, I was going to ask Neil before he said services about, restaurants and things that are kind of small discretionary spends that are service related, that ends up being pretty important. You can see it in the credit card data as well. Look, we default to the market, right? The market is going to understand these things and sort it out and filter it out. And as I like to say, the market can fib a little bit, but it doesn't lie for long. And so, when we look at, as an example, cyclicality making a new high versus defensives this week, right? That's certainly suggesting that whatever the impact of tariffs are, the bark is probably worse than the bite here. That's not going to be true for certain industries. Granted, there's going to be some backlash in those, but I think more broadly speaking, listen to what the market's telling you, and you'll be able to get a sense. Because if some of the hard data that Neil's talking about is going to deteriorate, the stocks are going to deteriorate ahead of that. That's not something that the stocks say, oh, the data, and then they decline. The stocks kind of get a sense of that. They might not have the same urgency, but you're not going to take something from a new high and just blow it out of the sky. The market will start to sense that. So I would absolutely watch the market, which is what we do, or listen to what we're saying, and that'll give you some indications as to where we are, the hard versus the soft data, and the impact that these things will have as we go forward.
All right, thank you for that question. Let's go around the horn. What to watch this week? Steve, we'll kick it off with you. What are we focused on from DC and policymakers?
Sure. So keep an eye out for any updates there on the trade and tariff front. I think the other thing we'll watch closer to home will be whether or not House Republicans can advance their version of the reconciliation bill. It's going to be challenging. We're already seeing that today, Friday, as of this morning. Not able to clear the budget committee. We'll see if that's resolved over the weekend. But even if it is, keep in mind that this is just the House version. The House, because of their instructions, were instructed to provide higher levels of savings, lower levels of deficit finance tax policy. Going back where we started the conversation at $2.5 trillion, the Senate is going to do their own product, and I think that's probably going to be a lower amount on the savings side. I think the Senate will look to reduce some of the cuts that the House version made to energy, clean energy in the Inflation Reduction Act sort of credits there. I think they're also probably going to not go as far as the House did with some of the Medicaid cuts. So I think those industries that may have been hit from the House mark, might see their prospects improve moving forward, because eventually both the House and Senate have to pass that same version. And I think if I'm looking at a calendar, Senate's probably going to work on their version in June. Those conversations between the House and Senate to resolve their differences probably takes place during July. And then the question is, can they actually get the votes necessary to pass that bill before lawmakers adjourn for August? I think that's where the timeline I'm looking at. And I mention that because where they end up on that deficit score in terms of the end of July sort of coincides with Treasury Secretary Scott Bessent's timeline to address the debt limit, which I think may happen by then. So when you have a lot of conversations about the debt and you're actually talking about adding to it, I guess that's sort of, when you're thinking at the end of July, something to keep an eye out for. So that's sort of next week and what it means for beyond.
Neil?
Yeah, on the data front, it's pretty quiet. We'll get the PMIs, the S&P Global Manufacturing and Services PMI, so we'll be keeping an eye on that. You'll also be getting an update on those data points globally as well. And then we also get some housing data, and I think the message from housing is new home sales soft, resales improving off a very low base. So an update on housing as well. There'll be a bunch of Fed speakers, but generally speaking, it's relatively quiet on the data front.
And Jeff, round us out.
Yeah, look, I think there's a couple things. First, when we see the early phases of this escape velocity, and we can call it early April as the beginning, and then the 20-day highs is kind of the culmination, and that check mark for it. The right message in that time is to own equities. I know a lot of people are going to say, well, I want to own this or I want to own that. What sector should I own? It doesn't, there's no consistency there. The consistency is actually in beta, and we've been telling people to own beta now for probably 2 months at least. So you end up with the beta trade and the market trade. The biggest sin is not to have exposure. That's what happens in those situations. That starts to shift now, and so what we're going to be watching, essentially 6 to 8 weeks into a rally, you start to take away the beta dominance. And you start to move more towards leadership. And so for us, we're watching relative strength, we're watching relative performance, we're watching what's breaking out, what's making new relative strength highs, because that or those are likely to be the leaders in the next phase of this cycle. So I think leadership from this point forward is absolutely critical and is something that we're searching for and watching literally every single day, twice a day, to be honest with you. The other just point that I would make here, which I think is interesting. It's a little nuanced. I'm not sure exactly how to square it, but we do have a lot of optimal exits, and we have these signals that clients get that tell us when these moves have tactically taken place that should probably be sold. We're getting a lot of optimal exits in semiconductors right here. That's not NVIDIA, that's not Broadcom, but it's a lot of the other ones, a lot of big names. And we're seeing it globally. So a lot of these bounces look like they've probably run themselves into a point where they need to pause and consolidate. At the same time, we're seeing optimal entries. These are oversold conditions in uptrends, developing kind of the traditional utilities, Duke Power as a example. So you've got really a dichotomy here of this oversold condition in uptrends, which we're generally buyers of, and those are some of your traditional electric utilities, and these overbought conditions in downtrends, which we're historically a seller of. So we'll watch that to see what that resolution is. I don't really know what's going on there, but certainly I think that's interesting and worthy of keeping an eye on as we plow forward.
That's great. Thanks, guys. That's a wrap. Be sure to join us again next week when we'll be back again and 1 week older, 1 week wiser. And don't forget to follow us on Twitter and YouTube, where you can also subscribe to that channel and watch. Until then,
if you're gonna host this, can you at least shave?
I did.
You come in the second time and you think, I mean, Neil's an old salt. He's fine. He can pull it off because he's been around. You're still like cutting your teeth here, and you're not shaving on the second time out. That's like unbelievable.
So join us next week. Join us next week when I'll have a shaved face and whiter teeth. And no more coffee, Steve. Anyway, I'm Steve Duttenhofer.
I'm Jeff deGraaf.
I'm Neil Dutta.
And I'm Steve Pavlik.
Thanks, everybody. See you next week.